please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Straight to the markets then, a volatile day of trade on Dalal Street, which saw a flat end on benchmark indices and underperformance by the mid-caps. Nifty managed to hold on to the 10,700 mark. The Sensex ended with a flat to positive bias. Bank Nifty closed with a 36-point gain. The mid-caps tanked also post-lunch. The index closed 1.5% in the red. Now straight to the other big story that we're tracking at this hour. Online hackers have stolen confidential data of formal sector employees who have enrolled themselves with the Employee Provident Fund Organization, or what you know as the EPFO. The commissioner at the EPFO, which is VP Roy, he has written a secret letter to the CEO of Common Services Center at the Ministry of Electronics and Information Technology, and the subject line of that letter reads, and I quote, "Data theft from ICT infrastructure of Aadhaar seeding services for Employee Provident Fund Organization." End of quote. Yash Jain is standing by with more details from the contents of this letter and how the EPFO is responding to it. Yash.
Well, Ritu, first things first, when I spoke to Mr. VP Joy, who's the EPF commissioner, he did not deny the existence of this letter which we are talking about. In fact, he went ahead and said that there has been no potential data breach on EPFO's end, but there might have been some data breach as far as the Common Service Center's end is concerned. Now, if you read the letter also which he's written, that really points out that particular portion. And let me quote him here. He says that the application running on the server, which is EPFO server, but is being remotely managed by Common Service Center team, which essentially falls under the Ministry of Information and Technology. The letter also explicitly makes it clear that there has been a case of stolen data, and let me quote him here again. He says that data has been stolen by hackers by exploiting the vulnerabilities of the website, which is aadhaar.epfoservices.com. Now, he's in this particular letter, he's also asked the Common Services Center team to really deploy an expert technical team in order to plug these vulnerabilities and other identified vulnerabilities as soon as possible. Now, soon after this letter was brought into public domain, there has been a press statement which has been issued by EPFO, which essentially says that such warning letters are a part of the regular operative and administrative purpose, and there has been no data breach whatsoever. And in fact, the Employees Provident Fund Organization will remain vigilant as far as containing and not letting any such data breach happen.
All right, Yash, we leave it at that. Thank you very much for joining in. And now to the big development from the deal street. And this one is a CNBC TV18 exclusive. It's no secret that both Walmart and Amazon, the retail behemoths from America, want a larger pie of the Indian e-commerce sector. But now we learn from sources that they're both in the fray for acquiring stake in Flipkart, that is India's largest online retailer. CNBC TV18 learns that Amazon has made a formal offer to buy out 60% stake in Flipkart. This comes amidst reports that Walmart is likely to reach a deal to buy majority stake in Flipkart very, very soon. Kritika Saxena, who broke that story, joins us now for more details. Kritika, now there are two players in the fray.
Well, Walmart is in the final stages of negotiation to look at acquiring Flipkart. We already know that Amazon has been in the fray, but what we understand now is that a formal offer has now finally been made. So far, Flipkart investors were holding out to see what Amazon has to offer. So this is what we have in terms of the details. They have offered to buy out at least 60% stake in the company versus Walmart's offer, which we understand is above 80%. Now, Walmart had offered to retain the current structure of Flipkart. In this particular case, we understand that Amazon has offered to merge the entity entirely, merge Flipkart entirely into the India arm if the deal does go through. They have also asked for a non-compete requirement of about 1 to 2 years by the founders, which is not there in the Walmart offer. As far as the financial parameters are concerned, we understand that the financial details are pretty much on par, but Amazon has offered a breakup fee, and this had been reported earlier as well, of about $2 billion, which essentially entails that if the deal doesn't go through between the two players, or for some reason the deal is terminated, there is a breakup of the requirement. Now, where do things stand as far as Walmart is concerned? We understand that investors, including Tiger, Axel as well as NASPER prefer Walmart's offer at this point in time. SoftBank is the only player which hasn't kind of made a decision. SoftBank does want to partially exit over here. We learned that Sachin Bansal was in US next week. Even the founders, for instance, are favoring Walmart at this point. Walmart global executives are likely to come in very soon. The conversations last week between the founders and Walmart were positive, and the negotiations are in the last lap. So it remains to be seen if Amazon does emerge the front runner. But yes, by the looks of it, Walmart still continues to be the very clear front runner here.
All right, that's Kritika. Thank you very much for joining in on the latest on the Flipkart deal. But now the cabinet today approved subsidies to sugarcane farmers for the produce that they sell to sugar mills. This move is aimed at helping an industry that is struggling with oversupply issues. The government has decided to give 55 rupees for every ton of cane that is sold to the mills by sugarcane growers, which means that the mills will now pay the farmers state-set prices minus the 55 rupees subsidy. Now remember, the centre does fix the price that mills must pay to cane growers every year, barring Uttar Pradesh, which, by the way, usually raises the rates to relieve the farmers. Now, sugar stocks rallied in early trade but soon gave up all gains as the industry calculated that a subsidy of 55 rupees per ton is just 1,400 crore rupees. Now, do remember, sugar mills owe 20,000 crore rupees to farmers as arrears. CNBC TV18's Archana Shukla, in fact, spoke to a sugarcane farmer association leader in Belgaum, and he said that a subsidy of 55 rupees will hardly make a difference in bringing down the arrears.
Paying 2,900 rupees is the obligation of the sugar factories. But we are getting only 2,500 rupees. The government pays subsidy of 55 rupees. What happens? There is gap between the prevailing market price of the sugar and the FRP. There is gap of 400 to 500 rupees. If the government pays 400 to 500 rupees subsidy, then it works out.
Well, to take that story forward, we are joined by Manisha Gupta with a breakup of the total arrears that mills owe to the farmers and whether a subsidy of 55 rupees will be of any help at all to reduce this huge burden. Manisha, over to you.
Thank you so much for that. Well, that really doesn't look likely because 55 rupees per ton is really a very small amount as compared to what the industry was asking for. Industry was asking for 75, and what you have in hand is 55. So as you said, the calculation really comes to around 1,550 to 1,600 crores. And that's a very small fraction of the total cane arrears, which stand at around 20,000 crores at this point in time. And mind you, this also comes with a caveat which says that this subsidy, the production-linked subsidy that we are talking about, also would be given only if all the government directives are filled by these mills. And the directives that the government has given out, one of course is that it is mandatory to export nearly 2 million tons, which is 20 lakh tons that has to go out of the country. Now, not many of the mills actually have been able to do that because when you want to export, there's a loss of around 14 rupees per kg that the mill will really have to face. In India also, we are trading at below cost of production, but the exports with the loss of 14 rupees per kg definitely does not make any sense. So that is the caveat really that has come in from the government. Until that is fulfilled, you don't even get these 55 rupees into the market there. So with the caveat and with the kind of number that we have seen come in as a subsidy, doesn't do much. And that's the reason you saw the sugar prices and the sugar stocks actually close into negative.
All right, so the sugar subsidy is not really going to move the needle on that. Manisha, thank you very much for joining in. But let's cut across quickly to the Indigo management that just reported the fourth quarter numbers, and they're addressing these numbers through a conference call. We listen into what they're saying.
Total capacity for the year was 63.5 billion ASKs, an increase of 16.4% compared to the same period last year. Our total capacity for the fourth quarter was 17.1 billion ASKs, an increase of 20.9% compared to the same period last year. This is lower than the capacity we had previously guided due to the grounding of some of our NEOs during the quarter. Our revenue from operations in the March quarter was 58 billion rupees, an increase of 19.6% over the same period last year. Our other income was 2.6 billion rupees for the quarter. Our RASK for the quarter was 3.40 rupees compared to 3.52 rupees during the same quarter last year, a decline of 3.2%. This decline in RASK was primarily driven by lower yields, partially offset by higher load factors. While our yields were down 5.6% to 3.31 rupees, our load factors were up by 2.8 points to 88.9%. We normally do not give guidance on how the revenue environment in the current quarter is shaping up. However, last year, we did share certain short-term yield trends post the demonetization event, since it had resulted in a sharp decline in yields during that quarter. Having said that, let me provide some color on near-term yield trends. Currently, we're seeing yield pressures in the industry. We saw that in the 0 to 15-day booking window, the fares are materially lower compared to a year ago. This is typically high-yielding traffic, and consequently, our yields have been impacted more than expected, and that is in spite of increasing fuel prices. In April, the revenue environment was weak, and year-over-year yields were down more than we were expecting, primarily driven, again, by the weak pricing in the 0 to 15-day booking window. That said, there have been some recent signs of yield improvements in this window, but it's too early for us to comment whether this will sustain over the quarter. Fuel prices increased by 11.6%, which led to an overall increase in CASK by 7.4%. Our CASK for the quarter was 3.30 rupees compared to 3.08 rupees during the same period last year. CASK excluding fuel was 1.94 rupees in the current quarter, an increase of 5.3% from the same period last year, primarily on account of the depreciation of the Indian rupee this quarter, compared to an appreciation in the Indian rupee in the same period last year. Similar to previous quarters, we also paid a GST of 356 million rupees under protest in the March quarter. Now moving to the balance sheet, we had total debt of 24.5 billion rupees at the end of March 2018. As we have discussed previously, we have started purchasing some of our aircraft with our free cash. We purchased 3 more ATRs during the quarter with our free cash, in addition to the 3 ATRs we had purchased in the previous quarter. We will continue to purchase more aircraft with our free cash going forward. Our cash balance at the end of the period was 137.1 billion rupees, comprising of 70.6 billion rupees of free cash and 66.5 billion rupees of restricted cash. Based on our cash position, the cash required to purchase aircraft, and the overall profitability for the year, the Board of Directors has recommended a dividend of 6 rupees per share for fiscal 2018. This is subject to approval by our shareholders in the 2018. This is subject to approval by our shareholders in the upcoming annual general meeting. Now let me give you guidance for the coming quarter and for fiscal 2019. We expect a year-over-year capacity increase in terms of ASKs of 18% for the first quarter of 2019 and 25% for the full year of fiscal 2019. So, to recap the year, we've generated record profits, we continue to focus on our costs, and have delivered consistent and profitable growth. With this, let me hand it back to Ankur.
Thank you, Rahul and Rohit. To answer as many questions as possible, I would like to request that each participant limit themselves to one question and one brief follow-up if needed. And with that, we are ready for the Q&A.
Thank you, sir. Ladies and gentlemen, we will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star and 1. The first question is from the line of Binay from Morgan Stanley. Please go ahead.
Hi team, thanks for the opportunity. My question is on the load factors. The load factors currently are close to all-time high. So when we look at next year, should we look at the March quarter load factor and look at that as a doable, or should we adjust for seasonality and benchmark it to the financial year 18 load factor? So So could you sort of guide a little bit about how do you see load factors moving in a year where capacity will grow by 25%?
Hi, Binay, it's Rohit. So I think as we've historically talked about, we don't try to look at load factor or yield in isolation. We try to maximize RASK. And there are various periods in time where sometimes the optimal RASK includes higher load factors and slightly lower yields and vice versa. So we will always look, and our revenue management systems are all trained to optimize RASK. So having said that, yields have been low this quarter, and that was offset a little bit with higher load factors. That'll not necessarily be indicative of what to expect going forward, and we don't normally give forward-looking guidance on that in any case. Right. Because, one of the questions we get on load factor is that, some of the peers are running at much higher load factors. Would you normally attribute it to them having a larger fleet of smaller planes, or like for an A320neo or an A320, what would be the ideal load factor? I know it's tricky to answer that, but any points on that? So Binay, as you probably have noticed over the last year, our load factors have increased on a year-over-year basis, primarily on account of us being much more aggressive, as we've signaled, in terms of matching competitive fares. So that's what you would see with load factors. Now, there's no ideal load factor, as I said, because it's always a combination of optimizing yield and load factor. Great. Thanks a lot. I'll come back in the queue for my second question. Thanks, Vinay.
Thank you. The next question is from the line of Sonal Gupta from UBS Securities. Please go ahead.
Hi, good evening. Thanks for taking my question. Rohit, just want to understand, again, taking load factors are on all-time high. Your load factors are running close to 88%. And still we're seeing the yields drop. So I just want to understand, in terms of how, even for the industry as a whole, it's not just you, the whole industry is running at all-time high load factors. And still we're facing this yield pressure. So could you just explain why this should, ideally you would think that at such high capacity utilization levels, you should actually start seeing it moving the other way, over and above the fuel price increase. But it's going the other way. So can you just explain the phenomena and what do you think?
Sure. So clearly we're not happy with what's going on in the industry with respect to yields, especially with respect to close-in bookings. However, in the past, we'd made this mistake where we didn't match the fares that the competition was offering. We've clearly indicated we will not make that mistake again. It's fundamental to our business that we should always remain competitive. Our competitors have been offering discounts to passengers through coupons, special email promotions, and we continue to match these offers. At the end of the day, our perspective is the revenue environment can always remain volatile, but we remain focused on our cost. And our cost structure is the lowest in the industry, and that provides us the cushion to withstand these short-term pressures. Now, we feel these fare levels, especially with today's fuel price levels, or in the light of the fuel price levels, these fare levels are just not sustainable. And that's why, again, our lowest cost structure gives us that cushion to withstand the short-term volatility. Rahul, anything you want to add?
Well, I agree with you entirely.
Sorry, if I could just clarify on the 0 to 15 booking window.
I'm sorry to interrupt, Mr. Sonal Gupta, but your voice is breaking, so if you could just...
Now, in a fresh twist to the Binani Cement insolvency case, the Kolkata bench of the NCLT, or National Company Law Tribunal, today ordered the Committee of Creditors to consider Ultratech's revised offer for Binani Cement. Now, the court has directed the resolution professional to accept the revised offer from Ultratech and place it before the Committee of Creditors within the next 3 days. It also allowed Dalmia Bharat to raise its offer to match Ultratech's, which we understand is now close to 8,000 crore rupees, if Dalmia Bharat so wished. The deadline for resolution of Binani Cement under the Insolvency and Bankruptcy Court has also now been extended up to June 24th by the court, adding in the days wasted in litigation. We also have on the phone line with us Sameer Kaji, and Nisha Podar will also join in to speak with him. Mr. Kaji is the senior advisor to Binani Industries. Mr. Kaji, if I could first quickly ask you a question Lassen, we know that your latest offer to the lenders was close to 8,000 crore rupees. Now you have the next 3 days to submit your final offer. Will you still go ahead with that 8,000 crore rupees, or will you look at changing that offer, given that Dalmia also now has an option to match whatever you say?
Is actually Ritu Ultratech to answer, but as far as my information goes, the bid amount will remain the same. We have already shared the contours of the bid initially, that is in mid-March and even subsequently April. I don't see any change on that.
Nisha here. So just very quickly, how hopeful are you of this process now going ahead without taking it to legal courts? Like, what are the legal options ahead of Dalmia, and could it be taken to NCLAT and therefore Supreme Court, or do you think that they will really stick to this? Because Dalmia Bharat's latest statement did not really say that we do agree with the court's order. They were surprised and they said that we will take more steps.
Nisha, it's very difficult for me to opine whether Dalmia will accept the decision of the NCLT when it is put up at the COC, or would Dalmia want to match the Ultratech bid close to 8,000 crores. They, of course, are within their right if they want to appeal at NCLAT post the COC wetting the offers of Ultratech, and if there is a additional bid from Dalmia.
Right, and clearly this matter is not now with you, because Ultratech is an independent, bidder in this particular case. Now it's not out of the IBC process, which you were earlier looking at. So at this moment, if Ultratech goes ahead, how will Binani Industries really gain from this? In very briefly, if you can state that.
We tried to look at a process outside the IBC only because stakeholder values were not maximized. Hence, this is now within the purview of Ultratech. We are totally out of it, and Ultratech would be a resolution applicant like anyone else who will make their bid known at the COC.